Later CPA and Associates, accounting done great by mates.
Hi there, I'm Daniel Later, founder of Later CPA and Associates, and welcome back to our ongoing series, Tax Strategy, right here, right now, where we are talking about great ways to reduce your tax bill and skipping all the jargon. So, this week, our topic is going to be solo 401k contributions, the employee and employer buckets. Now, a solo 401k can be one of the biggest tax strategy tools for a private practice owner because it has two contribution buckets instead of one. Now, many owners only think about the employee part and miss the employer part. So, our goal for today with this topic: understand the two buckets, how they work together, and how to avoid common mistakes. So, what is a solo 401k? A solo 401k, also called a one-participant 401k in the IRS jargon, is for a business owner with no employees, except possibly a spouse. Now, it is not a special new type. It's still a regular 401k. It's just using a one-owner option. Now, the big advantage of a solo 401k is you can contribute to both the employee and employer portions or buckets. Now, why does this matter for mental health practice owners? A private practice owner may want to have a lower taxable income and more flexible spendings, and a simple way to build long-term wealth. Now, a solo 401k can help you with these goals, and it can help you make your move from money I might spend to money building my future. And it can be especially powerful when you have a profitable year. Now, to get more into detail on the two different buckets, there's the employee bucket. This is the elective deferral. This is the amount you contribute as the employee. If you recall, if you've ever been in a job where you've had a 401k, you contribute out of your own salary. You receive less on your paychecks. That's the exact thing we're talking about right now. Now, for 2026, the basic 401k deferral limit for an employee is $24,500. Or 100% of your compensation, whichever is less. Now, this is the bucket that people usually first think of when they think of a 401k or a solo 401k. Now, special is the catch-up contribution. If you're over the age of 50, then the regular catch-up limit for 2026 is another $8,000. So instead of $24,500, it's now $32,500. Also, additionally, and these rules get a little weird, so I don't blame you if you don't remember them, but additionally, under the Secure 2.0 Tax Act from a few years ago, if you are between the ages of 60 to 63, you have a higher catch-up amount. And for 2026, that higher catch-up amount is $11,250 instead of another $8,000. So don't bother remembering all those numbers. I'm sure they'll change again, but just remember, over 50 catch-up amounts, you can contribute more. Now, that's the employee bucket. I'm sure a lot of you are familiar with how 401k contributions on the employee side work. But let's talk about the employer bucket. And this may be new, especially if you're new to having a solo 401k. Now, the employer bucket, this is the profit sharing contribution. This is the amount your business contributes as your employer. Now, this bucket depends on your business's structure and how compensation is done. A couple easy rules that we'll just touch on real lightly. If your business is an S Corp or a C Corporation, if you're a sole proprietor or single member LLC, operating with a solo 401k, the effective rate of contributions from the business is somewhere around 20%. Talk to your tax advisor to get more specifics. The calculation is a little harder, but it's around 20% of the net income from the business. Now, it's very important to calculate the exact amount of this employer contribution. It can get technical, so talk with your tax advisor for help with it. But if you want to max out your solo 401k, it's important you get that number right. So we talked about the two buckets separately. Now let's talk about those two buckets together. The total contribution for employee and employer. So for 2026, the maximum amount you could possibly contribute to a solo 401k is $72,000, not counting the additional catch-up contributions that we talked about if you're over 50. Now let's use a simple example just to illustrate what we're talking about here. Let's say a solo private practice owner has enough profits and wages to max out the plan. They can contribute up to $24,500 of their own salary, of their own wages, and the employer's side, an additional amount based on their wages or profit. Now, the goal is to add both buckets together to get to the allowed amount. So we talked about the employee contribution bucket and the employer contribution bucket. Now let's talk about them together and get at the total limits and some of the cool strategies that are available. So for 2026, the combined limit for a solo 401k with the profit sharing contributions from the business is $72,000, not including catch-ups for people over 50. Now there's a couple scenarios to consider. It's not common that I see a business can contribute the full amount. Usually they're talking about contributing something less than the total amount they could potentially contribute. And then we start looking at a decision of, is it better to put money into the employee bucket or the employer bucket first? Because if you can't contribute to everything, you can either evenly contribute to both buckets or put more into one and more into the other. Talk with your tax professional. This is where we can get into some really cool strategies where we're saying $1 here is not the same as $1 there. So keep in mind, it matters which bucket you want to put your money in if you're not going to contribute the full amount into both. Now, let's give a little example. Let's say a solo practice owner has enough profit and wages to max out their plan. What that looks like is they can contribute $24,500 out of their employee earnings. And they can contribute out of the employer's portion, the profit sharing portion, up to that 25% of wages or around 20% of net profits from the business. That maximum contribution will give a really large bump to retirement contributions for the year. Now, the goal is to stack both of these buckets up to the total allowed limit, if the cash flow supports it. And that brings us into some common mistakes we always must think of. First, and most important, this is the thing you should always consider first when making retirement contributions. Does your cash flow allow it? If your cash flow doesn't allow you to make the maximum contribution into a 401k, don't do it. You need that money for operating your business, for covering your living expenses. Make sure that your cash flow allows for a retirement contribution to the full extent possible. If it can't, there's no shame in contributing less in a year. A couple other mistakes. Remember not to only contribute into the employee bucket. You could be leaving the employer bucket out when it could be an advantage. Second, or another mistake is don't use the wrong pay number when you're calculating your total 401k contributions. If you calculate it wrong, you're either under contributing when you could put in more, or you're over contributing and you have to request it back. That's a mistake that's fixable, but it is a mistake. Another mistake I often see is don't wait too long. There's deadlines. There's contribution and plan setup deadlines for a solo 401k. Keep those in mind. Also, it's a lot easier to make contributions over an entire year span, a lot of small contributions to get to your max amount, instead of one large contribution at year end. That's harder to do. So keep in mind your timing. Now, a couple practical tips to remember as you start looking into your own solo 401k. Review your compensation strategy before year end, especially if you have an S corporation. This will tell you how much could be put into a solo 401k. Estimate your profits early so you can plan on your contributions instead of just guessing. Coordinate your retirement contributions with your tax estimates, your payroll, your other owner's pay, and any other tax strategies that are in the works. If your spouse works in the business with you, a solo 401k may create additional planning opportunities between both spouses. Now, some closing thoughts. A solo 401k is powerful because it gives you those two ways to contribute, the employee and the employer buckets. When you're using it correctly, it can reduce your taxes now and help you build wealth later. The biggest win is not just maxing out your contributions. It is using it as part of a full tax and cash flow strategy. A critical thinking question I'd like to leave you with: if your practice has a strong profit year, would you rather take all of that extra cash as taxable income now, or move part of it into a retirement bucket that may lower taxes and build long-term wealth? Next week, we are going to be talking about defined benefit and cash balance plans for high-income practice owners. That one's a good one. So don't forget to like, follow, and subscribe for future events and tax advice. Visit our website, latercpa.com. Have a great weekend and keep helping others to help themselves. And let us help you to do just that. I'll see you next time. Bye.